This is Horizons Middle East and Africa. Our top stories this morning. More time. President Trump extends the deadline for the European Union to face 50% tariffs until July 9th after a phone call with EU Commission President Ursula von der Leyen. Meantime, Southeast Asian leaders meet in Kuala Lumpur for the ASEAN summit to chart a path forward in the trade war between the world's two biggest economies. Plus, more sanctions. President Trump says he's considering economic action against Russia after Moscow launches another deadly night of missile and drone strikes across much of Ukraine. It's just gone past 8 a.m. across the Emirates, 6 a.m. here in South Africa. I'm Jennifer Zabisaja in Johannesburg. Great to be with you and happy Monday to you all. It was a busy weekend for President Trump and also for futures, as you can see there, especially when we consider some of the comments that we got from the U.S. president overnight, helping to lift risk sentiment. As we can see there, we're seeing U.S. equity futures, S&P futures up 1% there, and also Eurostock 50 futures also being lifted from that. That, of course, as we mentioned there, coming after President Trump made this decision to delay tariffs on all EU imports after that call with Ursula von der Leyen. If we take a look at the Bloomberg dollar, though, showing weakness to start off the week right now, down just about 0.3% there. We actually did see the greenback falling to its lowest level, since December of 2023, largely off the back of uncertainty with Trump's tariff policy Trump's tariff policy. Let's just take a look at Brent crude as well, up just about 0.3% to trade at about $64.96 a barrel. Let's bring you our terminal chart, though. This week, investors are gearing up for the Fed's preferred inflation metric later this week, but we are going to get minutes from the Federal Reserve. And ahead of those minutes, we actually heard from Neil Kashkari speaking to our colleague Haslinda Amin earlier today, stating that uncertainty is a top concern for the Fed and also U.S. businesses. He's also alluding to the fact that the Fed is in a wait-and-see mode regarding potential policy moves. This is just a look at our terminal chart just to see potentially where sentiment is going to settle in when we do get those minutes later this week. Let's get back, though, to our top story, and that is President Trump. He's saying that he is extending the deadline for the EU to face 50% tariffs until July 9th. That follows a phone call with European Commission President Ursula von der Leyen. We heard from the president earlier, speaking in New Jersey.
We had a very nice call, and I agreed to move it. I believe June 9th would be, July 9th would be the date. That was the date she requested. Could we move it from June 1st to July 9th? And I agreed to do that. And that she said we will rapidly get together and see if we can work something out.
And that's a quick about-face from Trump after he threatened those higher tariffs on the EU just last Friday.
Looking for a deal. I mean, we've set the deal. It's at 50%. But again, there is no tariff if they build their plant here. Right now, it's going on June 1st, and that's the way it is.
For more on this, we're joined by Bloomberg's John Herskovits in Tokyo. John, talk to us about some of the factors behind this trade dispute with Trump and the EU, and really what happened and what this decision was behind his about-face.
I have some
John, can you hear me?
Issues. I'm having trouble hearing the show.
It looks like we're having a bit of trouble with John Herskovits, but we will go back to him in just a bit to talk about some of those comments that we did get from President Trump over the weekend. Let's move on, though. The EU is said to be considering cutting more than 20 banks from SWIFT, the international payment system, as part of fresh sanctions to raise pressure on Russia. The new package may also include lowering a price cap on Russian oil and banning the Nord Stream gas pipeline. Sources say the European Commission is consulting member states over the plans. President Trump, meanwhile, says he is considering new sanctions against Russia after Moscow launched deadly missile and drone strikes across much of Ukraine.
Absolutely. He's killing a lot of people. I don't know what's wrong with him. What the hell happened to him, right? He's killing a lot of people. I'm not happy about that.
Joining us now is Bloomberg's executive editor for Middle East, North Africa, and Russia, Stuart Livingston-Wallace. So, Stuart, Trump expressing frustration with Putin, contrary to his comments over the past few months. Could we see more sanctions actually being applied, and would that lead to the end of the war in Ukraine?
Good morning, Jennifer. I mean, those are really tough questions. I mean, the obvious thing to go after here are the commodity exports. I mean, fundamentally, that is what is keeping Russia's economy going. Not the only thing, but they're probably the easiest ones to go after. However, there are some implications in doing that. Russia is exporting something like 3 million barrels a day of seaborne exports, and those are primarily going to China and to India. Now, I suspect President Trump doesn't care too much about China, but he may be more cautious about causing any harm to India. Furthermore, you take 3 million barrels off the market, and that's going to have implications for everyone's energy prices. And as we know, broadly speaking, he's in favor of lower energy prices. So that's a tough one to do. There are also some practicalities here of just how do you do it, because restrictions and sanctions of sorts have been in place for many, many months now, and it's not really had much of a dent in terms of the exports. So it's a tough one that he's going to have to answer over the next couple of weeks. As you said, it's clear he's getting increasingly frustrated with the total lack of progress in these discussions. I should say, for balance, he also expressed some frustration with the Ukrainian president in terms of the comments that he's been making publicly. So by and large, he seems frustrated with all sides on this one.
And Stuart, on the other hand, he seems a bit optimistic about U.S.-Iran talks that did take place over the weekend in Rome. Could we get closer to a deal on that front anytime soon?
I mean, it does sound like we're making progress, but again, you can hear the hesitancy in my voice. We've been here before. These negotiations have taken place over many years. And again, you have a real fundamental problem here in that Iran's red line is that it reserves the right to enrich some uranium, certainly up to the grade that you would require for a civilian nuclear plant. On the other hand, the red line for Israel is that Iran can under no circumstances have any capability to enrich uranium. So any deal that ends up with the ability to enrich, I think, is not going to be particularly welcomed by Israel. And thinking that forward several years, you know, again, that doesn't remove the tension that you've seen between those two countries.
Yeah, it's fascinating developments there. Stuart Livingston-Wallace, Bloomberg's executive editor for Middle East, North Africa, and Russia, joining us in Dubai. Thanks so much, Stuart. Meanwhile, Israel's military aims to take over 75% of the Gaza Strip within 2 months, according to local media accounts of a military briefing. The offensive aims to defeat Hamas or force the exile of its leadership and press the group to release the last of its hostages taken 2 years ago. Under the plan, the entire population of some 2 million people would be forced into 3 areas, making up just a quarter of the territory. Let's return back to our top story, and that is President Trump saying he's extending the deadline for the EU to face 50% tariffs until July 9th. That follows a phone call with European Commission President Ursula von der Leyen. Bloomberg's John Herskovitz joins us again from Tokyo. So, John, talk to us again about some of the factors behind the trade dispute between Trump and the EU.
Sure. The animosity with Trump towards the EU has been on display for some time. But what is really driving the U.S. now seems to be non-tariff issues. The U.S. has is seeing Europe as slow-walking the negotiations. They're seeing Europe as imposing regulations and lawsuits that are hitting American companies, making it difficult for them to do business there. Europe, on the other hand, we've had trade negotiators who say that EU is ready to reduce tariffs to near zero for a wide range of goods, and they're just trying to figure out what the Trump team is looking for. With this back and forth with tariffs on, tariffs off, how much, what level, it just adds to the confusion of this. And one thing that the EU has also proposed is a hardball tactic. They're looking at reciprocal tariffs on the U.S. if things go forward, kind of taking a page from China's playbook and pushing back and hitting very specific sectors of the U.S. economy if the tariffs are applied on the EU and its products.
And John, on the same day that we did hear those initial comments from President Trump, we did also hear from him threatening tariffs against smartphone makers, Samsung and Apple. Give us a sense of where that is potentially coming from.
Sure. Trump has been trying to get the manufacturing of smartphones moved to the U.S. Now, for companies like Apple, Samsung, there is an intricate network of providers, supply chains, and workers to put these phones together. Moving to the U.S. would just be incredibly cost prohibitive for them, would take a lot of years, and it's something that they are not looking to do. It would add cost to their production, it would add cost to consumers. So on the one hand, Trump wants these companies to produce their phones in the U.S., but we have these companies who want to stay in Asia. Apple has drawn Trump's ire for moving production of iPhones to India. Trump was hoping to get those into the U.S. And for Samsung, it's this company, Samsung Electronics, has spent a lot of money in the U.S. In Texas alone, it has spent tens of billions of dollars on semiconductor production facilities in Austin and in Taylor. I mean, it's made really significant investments in the U.S., and it doesn't seem to be getting some consideration for the amount of money that it's put into the U.S. and the thousands of Americans that it's employing.
I don't think Americans would want to see higher costs for phones, but we'll have to see how that develops. Bloomberg's John Herskovitz in Tokyo. John, thanks so much for joining us. And coming up, we'll get the market outlook with Blackrock Investment Institute as stock traders cheer President Trump's move to extend the 50% tariff deadline on the EU. This is Bloomberg.
There's no question that the shock of tariffs are stagflationary. The question is going to be ultimately how high do they settle at? Right now they're at a very high level, highest in 100 years. And how long a period both is this uncertain environment and how long are the tariffs going to last?
Minneapolis Fed President Neel Kashkari is speaking earlier. Now, U.S. and European futures right now are climbing along with Asian stocks as President Trump announced an extension of a deadline on aggressive European tariffs. Joining us is Ben Powell, the Chief Middle East and APAC Investment Strategist at Blackrock Investment Institute. Ben, great to have you on the show. Thanks so much for being here. Let's just start with some of those comments from Neel Kashkari. He also did say investors are really reassessing where to put capital globally. What do you make of some of those comments that he made earlier today?
Hi, fascinating comments, of course. The Fed is really, like all of us, I guess, obliged to wait and see. So I think whether you're a corporate CEO, CFO thinking about CapEx decisions, an investor thinking about where to deploy tactically your asset allocation, or indeed a Fed governor, we're all kind of reacting in real time to what is clearly a very dynamic set of circumstances vis-a-vis tariffs, tax, and potentially deregulation to come. So the Fed, even the mighty Fed, is a little bit less important, I guess. We're all playing second fiddle to the U.S. administration and the political kind of climate for now.
And yet we are seeing, as we were mentioning, futures lifting off the back of some of those comments that we got from President Trump. Are you reallocating your assets in U.S. equities, considering some of these latest comments? How are you positioning a lot of this uncertainty right now?
So we've stayed bullish at the Blackrock Investment Institute. We've been overweight U.S. equities in our tactical asset allocation frame throughout the big bullish rise, I guess, over the last several weeks. And I think the reason we were able to kind of hold firm, even in the face of the huge uncertainty around Liberation Day, was really being extremely well anchored in our core beliefs, which include the AI megaforce. So, you know, clearly, for sure, tariffs are very important, and they are going to be front page news maybe for days and weeks to come. But we shouldn't forget there are other things going on. We've got NVIDIA numbers later this week. Let's see what they say. But it does seem to us that the AI megaforce, clearly a critical driver of economic, perhaps even societal changes over time. But right now, the earnings kind of boom still continues in the AI space. Momentum there continues. And that's really clarity on that, I guess, is what gave us the conviction to hold firm, stay overweight the U.S. equities. And that's where we still are.
What about European equities, though, Ben, especially when you think about the context, again, President Trump delaying these tariffs? Could you potentially reallocate to Europe, excuse me?
I think everyone's thoughtful around diversification. Clearly, it feels like we're in a different investment geopolitical environment for now, and perhaps the kind of US exceptionalism era is at least a question. I think it's too sort of bold to be too clear that that's necessarily over, but there's a reasonable conversation going on about diversification, and that can take us in many directions by asset class and geography, including Europe. Europe still has some growth issues, but what it also has is some great companies. So even if I go back to my previous answer and look at the AI kind of tech boom, is that a European phenomenon? Not really, but do they have some great companies, individual companies, which are geared into that? They very much do. So I think for us at the Blackrock Investment Institute, our starting point would be the kind of sector environment, including tech and AI, and then looking if we can overlap that into different geographies, including the Europe, and perhaps we can.
Where do you position on the curve, Ben, especially if we take a look at some of the concerns around fiscal deficits, at least in the U.S.? What is your take on where best to position there?
We'd still be at the shorter end of the curve. So we still have a core conviction. We've had this for 3 or 4 years, actually, that the long end is going to continue to go higher, yields up, prices down. There's a few things going on there, but I think critically, we're all very uncertain, and that uncertainty for us as investors, you need to be compensated for that uncertainty. So when we look forward, let's say you're thinking about buying a 10-year bond in the US at 4.5, is that a good trade or not? We'll only know in 10 years' time if we manage to keep up with inflation, how interest rate policy kind of works out. So in a much more uncertain world, the term premium you should be demanding as an investor, we think should continue to rise. So we still think the long end of the curve, all over the world, by the way, not just in the US, but the US is obviously the big one. We still think the long end of the curve probably drifts higher over time, mainly because of this term premium concern that we've had for a few years and continue to have from here.
Fascinating. We have to leave it there, though. Thank you so much, Ben Powell, Chief Middle East and APAC Investment Strategist at Blackrock Investment Institute, joining us there in Dubai. Now, coming up, Treasury Secretary Scott Bessent says there could be several large trade deals in the next couple of weeks. That and much more coming up next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. U.S. Treasury Secretary Scott Bessent expects several large trade deals to be announced in the coming weeks and for more in-person talks with China. Bessent spoke with Bloomberg about the impact of revenue from tariffs and why talks with the EU are proving to be more difficult.
We have substantial revenue coming in now, and there is, at some point, there's an equilibrium rate, let's call it a Laffer curve, for tariffs. And I think we will reach that rate. The other thing that's happening is a lot of their tariff barriers or non-tariff trade barriers. A lot of these non-tariff trade barriers are coming down, so friction's decreasing there. And again, because we don't know where these tariff negotiations are going to end up, they won't end up being scored. But it's several $100 million a year, several $100 billion a year of revenue that will be used. For every $100 billion, that's $100 billion less of bonds that Treasury has to issue.
When you talk about uncertainty and getting more certainty because of the tax bill, some of the uncertainty, a lot of it is because of tariffs right now, because we're not exactly sure where we're going to end up. Do you have a sense when the economic community, the business community, will get better certainty on tariffs?
Well, we've done the 90-day pause. As I mentioned several times, we have 18 important trading partners. So what everyone should really focus on are those. We've done a deal with the UK. My sense is over the next couple of weeks, we're going to have several large deals announced. We have put a pause and a 90-day pause with China. I expect that we will be negotiating in person with them again. And then the president today, when we initiated the pause and the 10% are moving down from the April 2nd rate to the 10% level was contingent on countries or trading blocs coming and negotiating in good faith. And I think the president was getting frustrated with the EU. The problem with the EU, I've said several times, they have a collective action problem. There are 27 countries. They all have different needs. The Germans, they are interested in cars, the French in agriculture. And then you have Brussels negotiating with them.
U.S. Treasury Secretary Scott Bessent there speaking with our colleague David Weston. Now, here's a look at some of the other stories we're following this morning. Ghana's central bank kept its key interest rate at 28% on Friday to maintain downward pressure on inflation. Governor Johnson Asiyama noted the rise in the cedi is supporting the disinflation process, but the current level of price growth requires a tight policy stance. Inflation is expected to be around 12% by year end and back within target in the first 3 months of next year. Zambia's central bank also held its key interest rate on Friday, saying it expects the disinflation process to continue. Policymakers kept the rate at 14.5% after raising it by 50 basis points in February. Food inflation has begun to slow, with the prices of oil and corn declining. Corn output is expected to more than double this year after the El Nino-induced drought of 2024. And the Islamic World Premier Lending Institution says it's prepared to step up support for some of its neediest members. That's as the U.S. and European nations like the U.K., France, and Germany scale back foreign aid commitments for Africa and beyond. The Islamic Development Bank says it's set with about $5.5 billion of lending for development efforts this year. Recent funding approved includes €212 million for road rehabilitation in Cameroon, €188 million for Burkina Faso infrastructure, and €108 million for a rice project in Ivory Coast. Syria may also be a future focus after a decade of catastrophic civil war. Reconstruction has been estimated to cost as much as $400 billion. CEO Mohammed Suleiman al-Jasser met with the new Syrian central bank governor in Washington last month and said efforts are underway to access priority needs and explore pathways for engagement. And a quick check at your markets right now. We are seeing more positive risk sentiment feeding into futures right now, especially after we did hear from President Trump on Sunday and his decision to delay tariffs on all EU imports. Right now, seeing green on the screen for futures right now. Coming up, we speak to Zeina Rizk, partner and co-head of fixed income at Amwal Capital Partners, on the growing risks to the global economy. This is Bloomberg. This is Horizons Middle East and Africa, our top stories this morning. More time. President Trump extends the deadline for the European Union to face 50% tariffs until July 9th after a phone call with EU Commission President Ursula von der Leyen. Meantime, Southeast Asian leaders meet in Kuala Lumpur for the ASEAN summit to chart a path forward in the trade war between the world's two biggest economies. Plus, more sanctions. President Trump says he's considering economic action against Russia after Moscow launches another deadly night of missile and drone strikes across much of Ukraine. It's just gone past 8:30 a.m. across the Emirates, 6:30 a.m. here in South Africa. I'm Jennifer Zabasaja in Johannesburg. Let's just take a quick check at where markets are positioned ahead of a shortened trading week. It is a holiday in the U.S., but U.S. equity futures right now starting the week off in the green, as you you can see there, S&P futures up almost 1% there. That coming from a continuation of a relatively positive session in Asia after we did hear President Trump's decision to delay tariffs on all EU imports, that helping to boost risk sentiment. Also, Eurostock 50 futures up more than 1%, and we're seeing a lot of those gains reversing declines from the major contracts that we did see on Friday. The Bloomberg dollar index, though, on the other hand, showing weakness to start the week off, down just over 0.2% there. Friday, we did see the greenback falling to its lowest level since December of 2023. A lot of that is off the back of the uncertainty around Trump's tariff policy and also concern around the fiscal deficit, a widening fiscal deficit in the U.S., weighing on the currency there in the U.S. Brent crude up just about 0.4% there to trade around $65 a barrel. Let's just bring you our terminal chart, though, as well. Ahead of the week, we will wait to hear from the Federal Reserve minutes from the last meeting that we did get. We will also get the Fed's preferred inflation gauge. This is just a look at potential sentiment that we will see from these minutes. Just not too long ago, we did also hear from Neil Kashkari speaking about uncertainty being one of the top concerns for the Fed, and again reiterating that the Fed is in a wait-and-see mode regarding potential policy moves. This is just a look at potentially where sentiment may lie when we do get those minutes. Let's move on, though, to Asia. Southeast Asian leaders have started 2 days of talks in Kuala Lumpur, seeking to deepen ties with China and Gulf nations and mitigate the fallout from President Trump's tariffs. Bloomberg's Avril Hong is at the ASEAN summit and joins us now. So, Avril, talk to us about what we've been hearing over the past few hours so far.
Yeah, Jen, I mean, the focus of this summit certainly is about tariffs, trade, geopolitical tensions. What we've been hearing so far includes comments from the Malaysian Prime Minister speaking to a room full of ASEAN leaders and saying that he's reached out to Trump, asking for a US-ASEAN summit. Have a listen.
I've taken the liberty also to write to President Donald J. Trump to seek his understanding to organize a US-ASEAN meeting, which means we observe seriously the spirit of centrality.
Now, keep in mind that it's not just the ASEAN leaders that are meeting. Tomorrow, there will be a trilateral summit that includes ASEAN, GCC, China leaders. This is something that's happening for the first time at a time when these fast-growing regions are looking at diversification amid rising tensions with Washington. But the fine line here for ASEAN countries is that they're going to have to make sure that they don't send a message that amid these meetings they are realigning away from Washington, because don't forget, these 10 member countries are individually negotiating with the U.S. for lower tariffs. They don't want to antagonize the U.S. at a time like this. Now, when it comes to the diversification, the significance is also loud and clear for China. Keep in mind that we've already been seeing Chinese building of momentum when it comes to key infrastructure projects in the region. For the GCC countries, it's about courting new markets at a time when we're seeing potentially the need to hedge given the oil market volatility. And of course, for context, this is all coming not long after Trump's very successful visit to some of these Gulf nations.
And Avril, we're also getting indications, or we've heard that Chinese Premier Li was visiting Indonesia ahead of this summit, pushing for closer ties. What's the significance of this?
Yeah, Jen, we're going to see Li Qiang at this event in KL from Monday till Wednesday. Hear what he has to say in that big event, that Trilat tomorrow. But as you say, he was in Indonesia before this, and he had been meeting with the Indonesian leader Prabowo Subianto. Certainly, this comes after last month, the foreign and defense ministers from both the Chinese and Indonesian side met. And we've seen in recent years the Chinese and Indonesian relations bonds have kind of been weighed down given their disputed claims in the South China Sea. So this visit is seen as part of efforts to perhaps draw closer to the Southeast Asian countries, and it's also part of efforts to court the wider regional bloc. And of course, it wasn't just these meetings. We also heard how the sovereign wealth funds from both China and the Indonesian side, there are more investment ties to come, even though we didn't quite get details. They're also signing a number of MOUs. This includes in the areas of supply chain development. So it's about investment ties amid all this.
Great reporting on the ground there. Bloomberg's Avril Hong at the ASEAN Summit in Kuala Lumpur. Thanks so much, Avril. Great to have you. Now, Minneapolis Fed President Neel Kashkari says investors are reassessing where to put capital amid market volatility brought on by the tariff war. Kashkari says the current challenging environment is difficult for policymakers to navigate.
A stagflationary shock, if Jamie Dimon is correct, pushes up inflation, pushes down economic activity. But our monetary policy instruments either push up economic activity and inflation or push them both down at the same time. And that's a particularly challenging environment for policymakers to navigate. And that's why so many of my colleagues and I are saying we're really in a wait-and-see mode.
Joining us is Zeina Rizk, partner and co-head of fixed income at Amwal Capital Partners. Zeina, great to have you on. Significance, in your opinion, of those comments from Neel Kashkari. Were you surprised to hear him say some of these comments?
Good morning, Jen. The comments aren't really surprising because the tariff environment is still very uncertain. On Friday, we saw that the tariffs are going to be increased to 50%. As early as June 1st. Today, those were pushed forward. I mean, there's a lot of uncertainty, and I think that, as you previously mentioned, the risk of stagflation is real and the risk of recession is real. So it definitely makes more sense for the Fed to wait and see as opposed to move too early.
And Zeina, you say we're in uncharted territory. Where are we seeing this appearing? If we look across assets, where are you the most concerned about where this uncharted territory is taking us?
We're seeing a dollar weakness in the times where uncertainty, which is pretty much not very common to see. At the same time, the rates are still, the front end rates are still very high. The move that we saw in the long end comes from, in my opinion, both tariffs and the fiscal bill that was passed. That puts another pressure on the U.S. economy and another uncertainty there. So we have been seeing volatility in the market, mainly in Treasury yields. I think this is where the risk is mainly reflected. We have seen a shift a bit away from U.S. assets, but I think this is very preliminary and still very premature to think of alternatives.
Do you expect then for yields to continue rising then, Zeina?
I think that the long end yield will continue rising. There's an upward pressure on the long end yield. The front end, in my opinion, is going to remain where it is as long as we don't start seeing real hard economic data starting to weaken. We see some sort of decline. Soft data is very weak, but the hard data is still holding up for now. And inflation figures are still not in the environment or in a sense that shows enough comfort for the Fed to cut the front end.
What does that mean, Zeina? We have our colleague wrote a story about the 60-40 portfolio potentially being thrown into question, considering a lot of this uncertainty. How would you assess the portfolio balance, especially if you consider a lot of the moves that we are seeing across the curve?
There's a lot of uncertainty indeed, so that's why, in my opinion, it's the first time we go into such period of uncertainty, and we're pretty much paid to wait. So we're seeing yields moving at the same time. The stock market is being very volatile with a touch of weakness. In my opinion, the best way to do it in these markets is to be in the front end of the curve in the bond market and to be in completely uncorrelated markets such as private credit, for example.
And what about gold, Zeina? I mean, where do you hedge against some of this risk and uncertainty?
And we've seen gold have a significant and massive rally happening. How far up can we go? I'm not very sure. That's why I think that given this current market uncertainty, we'd rather be in either, yes, obviously gold is a commodity to be in. Oil has been very weak, and the front end of the fixed income, especially in our part of the world, in the GCC, is still offering you very good return, very strong fundamentals, and it's hedging you while waiting for the economic situation to unravel.
Zeina, let's also talk about oil. We have seen oil prices, at least this morning, steadying a bit, and yet they have been trending lower since earlier this year. What is the continued risk for oil prices in your view?
I think the risk on oil prices is under downward pressure. We have increased production. The Trump administration is very adamant on keeping oil lower. And a potential deal with Iran might also put downward pressure on oil. Adding to all of that, the potential risk of economic slowdown and recession. So we think that there's a downward pressure on oil versus an upward pressure. But for our part of the world, this downward pressure is not for where oil gets, it's how long oil gets this far. So if we move to lower oil prices for an extended period of time, this will obviously have more or increased pressure on our part of the world.
Yeah, and we're also waiting to hear from OPEC Plus on this. Is your expectation then we'll continue to see prices trending lower then?
Absolutely. I think that there's more risk for the downside as opposed to the upside on oil prices.
All right, we'll leave it there with you. Zeina Rizk, partner and co-head of fixed income at Amwal Capital Partners. Zeina, great to get you on. Thanks so much for joining us this morning and for your insights. Now, coming up, after President Trump's clash with South Africa's Cyril Ramaphosa, we look at what is driving his administration's Africa pivot. The discussion is next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. President Trump's meeting last week with South Africa's Cyril Ramaphosa was overshadowed by Trump repeating a debunked claim of genocide against white Afrikaner farmers. And that's not the only example of growing U.S. tensions with the continent. The administration is also canceling health aid, slashing humanitarian assistance, and reneging on development finance pledges. For more, let's bring in Bloomberg's Andira Oganga, who's joining us from Kigali. So, Andira, walk us through a little bit about how this relationship between the U.S. and the African continent has completely changed over the past few months.
Jen, it's like day and night if you look at President Joe Biden and if then you look at President Donald Trump right now. When Cyril Ramaphosa went to the White House, it was supposed to be a pivotal moment, not just for South Africa, but for the African continent. But it ended up being an attempted dress down. And this is in pure contrast to what we saw when President Joe Biden came to Africa last year in December. He was here to celebrate the pivotal role that the U.S. was playing in the $2.3 billion Lobito Corridor project, aimed at connecting critical mines in DRC and Zambia to the U.S. And that is where you see the difference in these relationships. Instead, in the last 4 months, what we've seen is President Trump scaling back on health aid, humanitarian assistance, funding to multilateral lenders like the African Development Bank, who have lost $555 million, and also tariffs of up to 50% that are going to scrap off any gains that AGOA had made on the African continent in terms of promoting trade between the U.S. and African countries. What we are ushering in is a new world order of transaction where every dollar that the U.S. spends has to make the U.S. safer, stronger, and more prosperous. And that's why we are seeing the U.S. trying to broker a peace deal between Rwanda and Congo, because Congo holds critical minerals that are essential for U.S. in terms of defense, technology, and also green energy transition. So the velvet glove is out of the window, and now we'll be seeing the Iron Fist.
Yeah, I mean, that's really a good summary of what we've been seeing over the past few months, Andiro. Can you also talk to us about U.S. aid? Because so much is being focused on how this funding gap is really going to affect a lot of the countries across the continent. But do we know yet who could potentially step up to fill the void here?
China has always been the biggest lending and bilateral trading partner to the African continent, and they're going to try and step up. We are seeing them donating money to healthcare programs, donating healthcare kits, and also committing more money in terms of infrastructure development across Africa, expanding road and railway network in Kenya and also in Nigeria. But the U.S., on the other hand, is calling out China and saying with all the money they're pouring out on the African continent, what they're doing is debt trapping the continent. And there's some truth to this claim, because if you look at the countries that have defaulted on the African continent, like Zambia, Ghana, and Ethiopia, China had a part to play, and they've been the slowest creditor to agree to restructuring terms. However, China has always made Africa feel like they are a worthy player and they're an equal partner on the table. So China is not going anywhere anytime soon. The Gulf is also making play on the African continent, trying to invest some of its oil money. And the European Union is also trying to warm back up to the continent after it had begun scaling back on lending. So we are likely to see new players try and come in, and that means that if the U.S. doesn't relook at its Africa policy, it's bound to lose more than it could actually gain by trying to forcefully create relations on the African continent.
All right. Great reporting there. Bloomberg's Indira Oganga in Kigali, Rwanda. Thanks so much, Indira. Great to have you. Coming up, Nippon Steel shares are off the highs in Tokyo after President Trump gave his blessing for a partnership with US Steel. We discuss why that deal is significant next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. President Trump has announced what he calls a planned partnership between U.S. Steel and Japan's Nippon Steel. Trump says the deal would create at least 70,000 jobs and add $14 billion to the U.S. economy.
It'll be controlled by the United States. Otherwise, I wouldn't make the deal. I went to the unions, to all of the local unions. They all wanted it. And I'm doing it because all of the congressmen came in, about 5 of them, and the others, I understand, are in concurrence, and they asked that I do it. Everybody seems to want it.
Let's bring in Stephen Stupczynski, who leads Bloomberg's energy team in Asia. So, Stephen, still a bit of confusion about what exactly we know, but give us a sense of what we do know and potentially what are the next steps.
This is the closest Trump has been to endorsing a deal between the companies. I think right now one thing that you have to keep in mind, of course, is that it's going to be a partnership is what he's saying, but it's unclear whether or not this is going to be a full-blown takeover or purchase. I think that is something that Nippon Steel has been pushing for. They wanted to purchase U.S. Steel from the beginning, but Trump and Biden before him had been opposed to that. In fact, Biden actually blocked the deal that would have pushed forward with Nippon Steel buying U.S. Steel because U.S. Steel is such a historic company within the context of the sector. Now, this looks like Trump is kind of taking a step back and saying, hey, maybe this deal can move forward. It's unclear exactly what will happen because he hasn't actually endorsed the purchase yet. Instead, he's endorsed a partnership, an investment. This might be the first step towards an eventual purchase, but the market is really unclear. And the Japanese government even came out and said that they're waiting for some sort of approval or some sort of indication from the Trump administration as well. It's going to take time, but of course, moving forward, I think it's something that the market will be carefully watching because stocks are reacting. They're waiting for a potential indication that this purchase will move forward because you've seen the U.S. Steel stock jump on the news on Friday, and even Nippon Steel rose quite a bit today. It's paired some of those gains, but it rose on the indication that this deal will move forward.
And Stephen, you were mentioning some of the market moves that we're seeing right now. Do we know yet how significant this could be, or potentially which side would be the most benefited if we do actually see this moving through?
I mean, this deal is very important for Nippon Steel. This is a remarkably important piece of their growth strategy. Now, to put this into context, Nippon Steel will depend on the United States for growth going to the future because Nippon Steel's main market has been Japan. The big issue with Japan is that growth there has been slowing down. And one of the bigger issues is that with the population in decline, you're also facing issues with demand there. And so, moving forward instead, they want to look at how can we make, a larger inlay into the U.S. market and purchasing U.S. steel, upgrading their factories, and selling more products into a growing U.S. sector where they see a strong a strong economic outlook, as well with the energy transition, more need for steel. This could be one area where Nippon Steel could really push forward because they've struggled so hard in their domestic market in Japan with the demand they're constraining.
And Stephen, do we have any indication what this could mean long term for the steel, the market for steel? I mean, do we know really what this could look like moving forward?
Yeah, I mean, I think the big thing that you take out of this is that this is Nippon Steel's way of countering a rising China. Right? China has flooded the steel market with plenty of cheap supply. They've dominated it. Over the last few decades, they've become the biggest force of steel production on Earth. Now, with Nippon Steel and US Steel kind of joining together, two of the larger other sides of the market joining in this way, this is really a counterweight to that Chinese growth. This is a consolidation that the market really needs and the industry needs in order to help sop up that large oversupply that has been pushed by China. And as you see, with the trade tension getting even worse, it makes sense, while this wasn't what Trump said, it makes sense that he creates as strong a steel sector as possible to try to counter what China is doing. So I think what you're going to see is, in the market, you're going to see a larger divide between China and then the West, and the West being, a potential Nippon Steel, US Steel partnership or company that has been joined together.
Fascinating stuff. Stephen Stupczynski, Bloomberg's Energy, who leads our Bloomberg's Energy team in Asia. Stephen, great to have you. Thanks so much for that update. Let's just take a quick check at where markets are positioned. We mentioned it is a holiday in the U.S., but we are seeing U.S. equity futures trading in the green, as well as Euro Stock 50 futures. That's where we leave it, though, for Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Stick with us for Daybreak Europe. That's next. This is Bloomberg.